Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 28th of November 2023 and the markets are looking quite interesting with the dollar continuing to fall on expectations that the Fed is done with hiking interest rates and that the next move could be a cut in as early as the first or second quarter of 2024. So the weakness in the dollar has sent the euro dollar up for the fourth consecutive session, and it's now approaching the key psychological barrier at 110, which is not very far from where we are trading at the moment. Price is also testing the 61.8% Fibonacci retracement level, where it had previously found some resistance last week. However, those losses lasted only 2 days before the bullish trend resumed. So price action is continuing to look bullish and making higher highs and higher lows. For that reason, I'm expecting the euro dollar to continue climbing higher in the near term outlook. Key support level to watch include 109.23, the high of this bearish candle, the last bearish candle prior to the latest move up. And the next level below that is at 108.87, the high of this candle, this big candle that was formed on the day when US CPI came in below expectations, which caused a major sell-off for the dollar across the board, not just against the euro. The weakness in the dollar and bond yields continue to support gold prices. Gold is now up for the fourth consecutive session. It is climbing above the 21-day exponential moving average and the 200-day moving average. It's now well above the 2000 level at 2025. So it's continuing to make good progress, and it looks like it's going to be heading towards the all-time high it had hit earlier this year at 2081ish. That will be the next major target because as you can see, we don't have any other key reference points to look out for. Perhaps the exception being the previous record high that was hit, when was it? On the 3rd of August 2020, which was briefly taken out earlier this year before gold went down. So the area between 2075, the high of 2020, and that of earlier this year at 2081, that's going to be the next major area of potential resistance for gold. Key support then on the downside, should we see a pullback, comes in at around this level right here at the 2010, the base of this week's breakout. Silver is also looking quite strong. It is continuing to climb after breaking this key level of resistance at 2350, a level which we had highlighted previously. Silver spent several days in consolidation there before breaking out again at the start of this week. We can see that there's a crossover of the moving averages, further confirming the bullish momentum. The next key level to watch is at 25, this red level here, which had previously offered significant resistance. So on the downside, should we get a pullback, the key level to watch now comes in at 2415ish, this area here, which had offered some resistance previously. Below that is the base of this week's breakout at around 2390, and then it's that key level of support at 2350. So ideally you wouldn't want silver to come all the way back down to 2350, but for as long as it remains below the most recent low, which was this level right here at 2325, for as long as it remains above that level, the path of least resistance will be to the upside. So global equity markets have been rallying strongly in recent days, weeks even, because of expectations that the Fed is done hiking interest rates, but this hasn't supported the FTSE, which is partly because of the strength in the pound. Usually they have an inverse correlation, and so far we haven't seen any significant bullish price action to get excited over in the FTSE, but it is on the verge of potentially forming a hammer candle on the daily time frame at around 74.50, which was previously support and resistance. We will need to see some follow through on the upside to confirm that the bullish traders are back in town. For more insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.